Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Tuesday. Yesterday was a holiday, which means this is a holiday short week as we get ready to wrap up the month of May, with tomorrow being the report that everybody's waiting on. It's the earnings report for Nvidia that comes out after the bell tomorrow. So all eyes today will be focused, actually tomorrow will be focused on that report because that's the last of the majors in terms of the earnings season. So kind of Nvidia closes out the earnings season for the most part. We have a few more smaller companies that will report through the end of the month. But as we get into June, two things are going to happen. First of all, the buyback window will start to close around June the 15th because we're going to be 2 weeks out from starting earnings season for quarter two, which begins in July. Yeah, by the way, we're halfway through the year. There's about 25 weeks left before Christmas is here, so it's coming. So this is going to be kind of an action-packed week as we wrap up the month, get ready to go into June. This morning, futures are sharply higher because President Trump delayed the tariff, the 50% tariff on the EU, till July the 9th, I think. But he's pushed it out a month. So a little bit of relief on the markets. The deal with the EU, the trade deal with the EU, should be pretty easy to get to. So a delay here makes a little bit of sense. Get something hammered out with the European Union pretty quick in terms of a trade deal. So anyway, markets are kind of a relief rally this morning. It sold off in the end of last week over concerns about that tariff. So again, with that lifted now, this kind of stick and carrot, we go back to that. Markets are reflex rally this morning on that. Decently strong, but we'll talk about what that means here in a few minutes. We get to the before the bell. Out of the government over the weekend, interesting, I was just telling John Penn this, Doji has found $60 billion in spending that they're going to be going after. 5.2 million credit cards. It's over 5 million, but there's 5 million plus credit cards that belong to federal employees. And they've been going through the records, finding spending on restaurants and bars and travel and Vegas and UFC fights and pay-per-view fights, those type of things. Here's the more interesting twist to that story. There's only about 2.5 million government employees. So how do I get one of those credit cards? I just say it. But anyway, so hopefully get some more spending cuts along the way. Of course, this is big because the big concern here as of late with the bond market and everything else is about the rising debts and deficits. So great, we're going to pass this big beautiful bill. That's going to help create some more economic growth. That's good. This Friday's report is going to be talking about the debt and the deficit and the fallacy of the CBO and the problems with the CBO projections. And of course, this has been the latest kind of shtick coming out of the media is like, oh my gosh, the big beautiful bill, it's going to cause this big surge in the deficit. And that's why rates are going up. No, that's not what's going on at all. But more importantly, the issue is that there's a lot of flaws to how the CBO predicts and scores these bills, right? They don't include future transactions. They don't future adjustments. They don't include future actions by, what happens. It's just basically a set kind of trajectory. They exclude a lot of other types of actions within the governments that don't get included in that scoring. So things never turn out the way that the CBO actually expects. So it's in predicting anything 10 years out in the future is pretty pointless anyway. But this really goes back to, Ray Dalio's lately has been on that as well ever since that bill came out. It's like, we're going to have a deficit crisis in 2 years. I've been getting this email. He's been saying that since 2010. And right here it is 15 years later. He's still on this kind of same shtick saying a debt crisis is coming. Maybe it will someday, we'll find out, but it's not today. And so, we need to focus back on making money and what's going on with markets and dealing with earnings and the things that actually matter relative to the market itself. So again, we'll have that article out for you on Friday. This weekend's newsletter, John Penn did me a favor this weekend. He asked ChatGPT about how to navigate the markets. particularly when it's volatile. So ChatGPT gave us a very interesting answer. We'll discuss that in this weekend's newsletter as well. So make sure you go to our website, realinvestmentadvice.com. Make sure you subscribe there for the newsletter, the daily market commentary. All that's there for you. And of course, also on our Substack account at Lance Roberts. And this morning, we are having our premiere video live stream on our Facebook page.
No, YouTube.
Sorry, on YouTube. I thought you said Facebook.
I was wrong.
He was wrong. On our YouTube. So we are now streaming to YouTube as well as live stream. So there you go. So just another platform for you to go get to. So we got all kinds of stuff going on. Anyway, very well. Now, all right, let's get to what you need to know before the bell this morning. As I said, the market sold off last week. And we had talked about the market being overbought. We were kind of extended, and we needed a bit of a correction. We got that correction back to the 200-day moving average. Again, we talked about this kind of coalescing level of support. You have the 20-day that's now rallied back to the 100-day, the 200-day as well. It's all right here, so there's a ton of support sitting right here at 57.90. Markets are going to bounce nicely off that today. So we've had a nice little test of the support. And so if we can kind of continue to hold above this, continue to consolidate, that's actually very bullish for the markets. Now, the trick here, though, is we are triggering a MACD sell signal from a fairly high level, as well as we're not oversold yet. So again, we're not done with this kind of this correction consolidation phase that we've had after this very, very strong run from the lows. So there is risk here to the markets, at least temporarily, that we're going to have some more consolidation, could have a pullback. The 50-day moving average is sitting at 57.30. So if we get some more news on the EU, that's not going well, whatever it is, we could certainly see this market sell off here a bit more because of the market still being fairly overbought on both the momentum and relative strength basis. But the good news right now is that we're going to try to hold that support today. But again, we may be very limited to the upside. Again, the 6,000 level on the S&P is probably going to be a bit of a challenge here for a bit until we kind of work through some more of the concerns in the markets. And also don't forget that the month of June tends to be one of the weaker months of the year. So again, as we start losing the corporate share buybacks around the middle of the month, and as we start heading into earnings season, if there's concerns about the strength or veracity of the earnings season coming up and for quarter two, we could see this market struggle a little bit more. And that would not be uncommon for the month of June. Now, July tends to be a much stronger month. And of course, that's also when you have corporate share buybacks come back as well towards the end of the month. So again, we're about to get into a little bit of period of weakness here. So again, if you haven't, with markets, kind of very extended, very overbought, very deviated, you've had a very big run here. If you haven't taken some profits, rebalanced some risks, today's a really good day to do that. Use this rally today, take a little bit of money off the table, and it doesn't mean sell everything. It just means, if you have a position that was, 2% of your portfolio, it's now 3 because of this rally, trim it back to 2. Do a little bit of nipping and tucking and pruning and weeding into your portfolio. Stuff that's not working, take it out of the portfolio, right? You can always come back to it later. It just means it's not working right now. So kind of look at your portfolio, look at your allocation, look at your diversification, make sure that you're kind of set up properly. And this is a really good point with this rally to start doing some of that work in the portfolio. Don't wait until the market, don't try to, say, the market might go up a little bit more after today. Maybe, right? But, trying to wait for that perfect moment typically gets you trapped in the next down leg of the market like we just had back here in April. So again, then you get trapped. It's like, well, I can't do it now. I got to wait for a rally. Well, here's the rally to do that. So take advantage of that. Rebalance your risk a bit. Doesn't mean get super negative, but just put a little bit of cash in the books here. We're going to potentially have a weak month as we go forward. And again, this market's still got some work to do here before we kind of get back on firmer footing. So again, just be a little cautious here. That's what you need to know before the bell this morning. We'll come back. We're going to talk about anchoring today. I told you I was going to have this article out. This is one of the biggest problems that investors face. So we're going to talk about anchoring and how to solve that problem this morning with John Penn. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, as I was saying, we're running a new test feed today. So if you look at our show, it says Restream test feed today. We're running a new piece of software called Restream. And this is going to allow us to multi-stream on multi-platforms. So not only will we be able to watch the show here eventually on just YouTube, but also on Facebook, Twitter, anywhere that you kind of hang out on social media, we'll be able to stream the show live on multiple platforms at one time. So we're testing a new piece of software today. So if anything goes wrong, it's Brent's fault.
No pressure, Brent.
No pressure. Brent has a note on my thing that says 20 ancient English words that deserve a comeback. One is lethologica, which is I can't remember that word. It's the inability to remember a word or name. Now, I've already forgotten that word, but yeah. So a couple of things good morning, John. How are you?
Good. Good morning. How are you?
Good. Is very well. One of the things that we run into a lot as advisors, and one thing I told you, I've had this article coming for a couple of weeks. We kept getting sidetracked with tariffs and other stuff, and so I kept postponing it. But this is one of the mistakes that create the most problems for investors. And John and I were working with a gentleman during April 6th, right? April 6th, April 7th, we're in the middle of the tariff meltdown. And John sent me this email from a gentleman who's very upset. He's like, I don't understand why this, I'm losing all this money. What's going on? And he's like, why am I invested in this market? And I go, because you'll miss out on the gains if you're not. And then immediately that day, that was the low of the market.
Yeah, turned around.
And again, his portfolio was down, like from the peak, market was down 20%. His portfolio was down like 2%. Right?
Less than 2.
Less than 2. So, but again, it's all about perspective and anchoring, right? I'm losing money from the high water mark in my portfolio. So again, I've talked to you for a while. This is one of the biggest challenges we face as investors is anchoring. And anchoring is when we select a figure in time. I tell you one of the interesting things about anchoring is home prices. John, how many houses have you owned in your life?
3.
What was the price you paid for your first home?
So the first one was a townhome, and I think all in, I think it was about $65,000.
Yeah. You remember that number? What'd you sell it? Do you remember what you sold it for?
We sold it for, I want to say, just over 70, around 72, 73,000. Made a little money on it.
Yeah, you didn't stay long enough.
Yeah, that's right. Yeah, actually, you know what? In looking back, so we sold the place. You're right. We sold it prematurely because our children. We were Sean and I were just married.
Yeah.
And it was a 2-story, 2-bedroom condo, and the bedrooms were upstairs. And we had daughter number 1. Mm-hmm. And then we were expecting daughter number 2.
Right.
So as a dad, what did I do? I freaked out. And I said, you know what? We need more space. And then looking back, we could have easily made that work.
Sure.
Because the girls are so young, they could have shared a room.
Sure. Absolutely.
Yeah, absolutely. So yeah, we did sell it too early.
But interestingly enough, you remember those two numbers. You remember those two numbers. Now, when you moved into that first townhome, and you went out to eat that first night, what'd you pay for dinner, and what did you have?
Cannot remember.
There you go.
That's it.
So this is anchoring, which we anchor to very specific events in our life, and typically we anchor to a value of something at the time. And this is the interesting thing about houses is that people buy a house at, they pay $135,000 for a house, and they live in it for 25 years, and they sell it for $250,000, and so. They made $115,000 on the house, and they're like, I made so much money on this house. Well, what they forget is that the taxes, the maintenance, the upkeep, you probably lost money on the house, right? But you anchor to those 2 points. And this is a psychological thing that we get into with very big things that we deal with, big and mostly revolves around numbers or values of something. People can often remember maybe the first time they purchased a car, what they paid for it, because it was a big life-changing event. We remember that. The same thing applies to portfolios. We remember where we were at some point in time because it's important to us, and then when something changes in that, we anchor back on that period. And Brent, can you bring up this fear chart for me? Thank you. I'll spit that out too. So as we go through these psychological evolutions of the market cycle, and this just happens over and over again, we're very optimistic. We go through exuberance, euphoria. Then markets start to decline. We get a little bit anxious, and then as they decline more, just think back to April now, late March, early April. Where were you on that cycle, right? Fear, despair, panic, capitulation. Where did you sell everything? This is the cycle we go through. Now we're back up to optimism again, right? Markets are back near highs where, markets are going up. And so we're kind of just back to that optimistic level again. But this is why we make so many investment mistakes, is because during the decline, we focus on certain aspects of the markets. And as an example, before the big sell-off, in April, we were down like 10%. And from the peak. And so when you're down that 10% from the peak of the market, you're going, oh my gosh, I'm down 10%. What do I do? But that was the peak, right? That was the high watermark of your portfolio. Doesn't really account for the fact that even though you're down 10% at that point from the peak, you were only down about 6% for the year because the market started higher than it had begun the year. But again, this is where we start to factor things in. So what if we start changing psychologically about how we look at our portfolio and start changing our points of reference? Because what's the real question that we want to answer, right? Is, are we making money? Despite the ups and downs and the volatility that goes on in the markets, are we making some money? So using that same kind of point in the market where the markets were down 10%, that was just before April the 6th. Let's just go back 1 year. And let's change our anchor point. And see, this is one of the mistakes too. Anchoring also starts from the standpoint of where, what the markets tell you to do or what the media tells you to do, which is how was your return from January the 1st to January, December 31st, right? You anchor on that year. That's anchoring as well. How did I do this year? A to B, right? That's anchoring because now I'm anchored to the January 1st data point. How are you doing this year? Well, that's January 1st to now. We're not even finished with the year yet, but now you're anchored on that January 1st point. So always take your portfolio back today, 1 year. How are you compared to 1 year ago? Well, at that point in time, you're still up 11% over that last 1 year period. If your annual rate of return that you need is 6% a year, you're almost double what you needed. But I encourage you to actually step that back a little bit further and go back 2 years. Because again, once you start expanding your time frame, and actually not 2 years, but in this particular case, go back to COVID. Let's go back to the COVID peak. Where are you now, right? So now you've had a 63% increase since the COVID peak. And so now when you put that into perspective, right, that little decline, that little 10% decline we had is just normal. Still in an uptrend, you're still up 63% in your portfolio from where you were. Now all of a sudden this decline, it's not so bad.
Yeah.
And that's the point you want to try to get to is pick an anchor point, 2 years, 3 years. Give yourself some time frame when you look at your portfolio to strip out that emotional bias and say, I'm still okay. I'm still growing money. I'm still in the green, right? And I'm not losing money. I've just given up some of my gains right now. So what should I be doing next? And this is, we wrote on April the 6th, the hope and the fear. We said, look, markets are so negative right now, you should be looking to buy. And the last line in that article said, if you're thinking about selling everything, maybe you should be buying. Because that's that emotional response. But anchoring, and this article's on the website. I posted it on Friday. It was a little bit late because I'd been having to push it out because of other stuff that was going on in the markets. But it's on the website now. So if you just go to Friday or go to our Substack page, it's there for you so you can read the whole thing. I've included 7 trading rules to follow in that to help you fix your anchor points as well. But again, just change the way you look at portfolios and your returns. And when you start to anchor on different longer term time frames, it can take out a lot of that short term emotional, angst that lead us through that cycle of emotional roller coasters that make us make bad investment decisions or panic sell at lows, those type of things, right?
Yeah. So going back and changing that point of reference, some of the most successful investors that I see that avoid anchoring, they keep a spreadsheet, lots of spreadsheets, and these go back 5, 10, 15, 20 years, and they can see where they started and how they've progressed. And it's not just market fluctuation they're paying attention to, it's their savings rate as well. And look where they were 5 years ago, 10 years ago, and where are they today? So is this 10% move really a big deal?
Yep.
It helps you kind of take a step back and look at the bigger picture.
That's right. All right, quick break. We'll come back. We'll talk a little bit more about that and got some other stuff to get into this morning as well. Don't go away.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize minimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Retirement looks a lot different now than what it did many years ago. It's just maybe working less. Still want to contribute and be active in the community.
And
Absolutely.
plus, when you're 70 and you can make TikTok channels and make money off of it.
The Real Investment Show podcast.
Is that what you're going to do?
I've already started it.
Oh, okay.
It's OnlyFans for old people.
Oh, my goodness.
At realinvestmentadvice.com.
Want to see my feet?
I'm out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So we were talking a little bit about anchoring a second ago and just kind of, fixing that kind of view on your portfolio. The things that we do wrong is and I'm going to write an article about this as well in the next week or so. But like during the day, I don't have the media on. I don't have market data on to any degree. Because it affects my research on what I'm doing. I'm trying to look at earnings and fundamentals and those type of things and build theses for portfolios, et cetera. So I turn off all the noise. I don't look at the portfolio during the day very often, unless something, major is going on within the markets. There's been some type of news headline or something. But most of the time I don't even look at the portfolio during the day because it doesn't matter. There's nothing I can do about it in the middle of the day. Anyway, so the best thing to do is just turn off the noise and focus on what matters with your portfolio. The worst thing that we did for investors was passing the SP Act back in the late 90s, which required that all information goes simultaneously to all investors. And so we had this immediacy of data that was going to investors. And so you get these immediate, any report from a company or any headlines just immediately right there in your face. And so now we're all just reacting to this news headline. The market is just driven by headlines every day. What's the latest headline? Market's up. What's the latest headline? Market's down. Sometimes these headlines mean nothing in the near term or even in the long term. Sometimes but markets are reacting to this because now we've all gotten into this immediacy bias of the markets, so we're just trading off this news constantly. And we're constantly looking at our portfolio all day long. We're at work, we're supposed to be building buildings or whatever we're doing at work, and yet we've got one screen up, with our portfolio on it. We're worried about what that's doing. That just leads you to make worse and worse mistakes. And the data proves it out. Over the last 40 years, investors have vastly underperformed the benchmark index by almost 30% because they trade themselves into bad positions. They allow that emotional bias to overtake their control of their portfolio. And so they're just responding to markets rather than planning and investing and growing money. And, sure, there's people that do better. There's a lot of people that do a whole lot. Well, there's more people that do worse than the average, right? But there's a few people that do better. That's why it's an average. But again, if you can turn off some of this news, you will perform better. Let your portfolio work, build the right allocations, build your diversification, you'll be fine. But again, we just do all these kind of wrong things within our portfolio.
Well, it's emotional, and I kind of, and I've said this before, but it's like the more you handle your portfolio, and I've made this point, I don't know, a couple weeks ago, but it's so appropriate. It's like a bar of soap. The more you handle it, the smaller it gets. So sometimes it's better to just like Lance said, just let your portfolio work, especially if you understand, like if you understand what you own and why, right? You'll feel much better if we get into some periods of market volatility, and not to make light of what we just went through just a couple weeks ago in April, but when markets were down at the peak, 19%, if your portfolio was down, at all. And if any sort of downward movement caused you anxiety or for you to lose sleep at night, it's okay to take a step back and just reevaluate, okay, what really is my investing persona? How much risk do I really need to take? Because, I can't, we all want equity returns.
Right.
But I don't want to take any of the risk. Well, the issue is, the price of admission. If you want some equity-like returns, the price of admission is you have to be willing to accept some volatility.
Yep. And
it just seems like we, as investors, we want all this return, but I just don't want to have any downside in my portfolio. It's just not realistic.
Chad just gave me a really good idea for a new podcast.
I saw you smiling over there. I was waiting. I saw your gears turning. So I was like, what's going on?
So I was actually just reading an article that one of the biggest booming video channels that are in the marketplace today, they're getting the most views, are how to do it channels. And because apparently as Gen Xers, we did not raise our children right. And so they don't know how to change tires and change their oil and
change a battery, jumpstart a vehicle.
Yeah, they don't know how they change a light bulb. That's actually a true story. They don't know how to change light bulbs. So they're actually flocking and these channels on how to do basic stuff in life, and there's just how to fix things, are booming on the internet, right? Because all these Gen Zers are now sourcing YouTube on how to fix problems they're running into. So I'm just thinking we come up with a new podcast. It's called My Two Dads on Money, and we can we'll give fatherly money advice to young kids.
Okay, I like that.
Yeah, we'll just call it My Two Dads.
My Two Dads.
My Two Dads.
We'll have to bring our kids on. You want to do that?
My kids are stupid.
Oh, my goodness. Hope you're listening this morning.
My kids don't listen to me.
Well,
that's why they get nothing. They get nothing.
No soup for you.
I'm joking. My kids are brilliant. Although my daughter's having to take. So my daughter's going to Baylor.
Oh, very good.
She got accepted.
Great school.
She got a scholarship. She got academic scholarship, so she's going to college.
Congratulations.
Yeah, no, she's very, very smart. Anyway, so she's got to test. She wants to test out of one of the math classes.
Yeah.
And it's been about a bajillion years since I've done calculus. And so she's asking me these, and I'm looking at this oh, damn.
But this isn't how they taught it when we were your age.
No,
Kiddo.
it's actually,
it is different. There's a different methodology now to how they solve complex math problems.
It is hugely different. There was one of the questions was, you sold 370 books. You sold 66 more math books than you did physics books. How many books did you sell of each? And I was like, well, and so in my head, I'm like, well, that's easy. I just take 370 divided by 2. That's 185. 66 divided, cutting that in half, and then add 33 to that. It gives me 218 math books and 150. I can't remember the exact numbers. 157 physics books. And she's like, how'd you do that? And I was like, well, it's just this, right? It's basic math. And she had to write this whole long formula to get to, and she gets through this formula. It takes her like 5 minutes, right? I did the thing in my head. She's writing this formula. And she goes, you're right. And I was like, yes.
Yeah.
it's right.
It's old school right there, honey.
Yeah, I know. But they have to do it a different way. Anyway, that was that. I forgot what was on. Oh yeah, so we'll start this My Two Dads podcast. I love it. So
right.
If y'all like that idea in the chat, give us a 1, and we'll put it together. So, because there was people saying they wish you were their dad. So
I was their dad.
Yeah.
Well, how sweet.
They don't want me as a dad because I won't give them anything.
It's about balance, right?
Yeah, balance for me works like this. It's like this is my side of the. It's all on my side, nothing on your side.
Well, I haven't, my apologies. I haven't looked at the chat this morning, but now I will. So thank you all for I feel the love right here. Appreciate that.
Anyway, I forgot where I was now, but I got off track. 6 secrets that clients keep, the clients keep from advisors. This was an interesting article that was out on thinkadvisor.com, and it's an interesting kind of concept because it's like when you go to the doctor, and the doctor says, you walk in, the doctor says, okay, doc, what's wrong with you? It's like it's kind of going to your doctor and saying, I don't know, you're the doctor, figure it out.
Yeah, and you're filling out the questionnaire. What sort of extracurricular activities do you like? Do you smoke? Do you drink? Oh, no. Well, what brings you in today? I don't know, doc. Just not feeling so good. Well, according to your questionnaire here, you have a perfect bill of health.
Exactly. Yeah. Don't know why you're suffering from cirrhosis, but there you go.
Why do you have emphysema? Not to make light of that, if anybody out there does.
Well, right. No, but no. But this is the same thing. Is that people do? It's like when they meet with their advisor, they sit down with them, and it's like, oh yeah, I don't have any credit card debt, or I don't have any debt at all. And one of my favorites is people when they're ready to talk about retirement, they go, yeah, when I get in retirement, I won't spend more than say $2,500 a month. And I go, well, how much are you spending now? It's like, $20,000 a month. Yeah. It's like there's no way.
It's like and let's break down where that 20 grand is going. Okay, so here's, if you have a mortgage, here's what you're paying on that. If you're paying rent, here's what you're paying for food. So where's all this other stuff going? Right. And then that's when it usually starts coming out on, oh, okay, well, here's the asset side of the balance sheet. But let's talk a little bit more about that liability side, right?
Like, literally, I could live on $2,500 a month. The other $7,500 goes to my wife's Amazon account. So that's not true. That's not true. My wife is very frugal, actually. I just make fun of her. So she's actually traveling today. Yeah, she's getting on an airplane right now to go to a Bitcoin conference.
Wow.
Yeah.
Where? Curious, can I ask where is the conference, or is that secret information?
Oh, no. Okay. It's in lovely Las Vegas.
Okay.
Which is,
of course it is.
Absolutely her least favorite place on the planet. She hates going to Vegas. But yeah, she's going. So my wife sells liquefied natural gas, and part of what you need for Bitcoin is a lot of power.
You need fuel.
And one way to get power for doing Bitcoin mining is through liquefied natural gas, which is why we own natural gas pipelines in our portfolio, because of the future of power demand through both AI and Bitcoin. So anyway, it's going to be very interesting. And by the way, I asked her, I said, when you go online to get your ticket, see if you can pay for it in Bitcoin. And they could. She actually could.
Yeah,
one of the few places I've seen where you actually make a transaction in Bitcoin. So anyway, she's heading out today. We'll come back, talk about Nvidia's earnings coming up tomorrow, and also wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just getting ready to wrap things up tomorrow. Tomorrow. Nvidia reports earnings, and one of the big things that, as constantly a kind of a concern about Nvidia is kind of the future of AI, and what does that mean for Nvidia? Of course, the tariffs, the impact of China, those type of things. That's all certainly a concern. When you take a look at, I just saw a recent video. I sent it out to Michael Leibowitz over the weekend. There was Jason Wang was making a presentation about some of their new chips that are coming out, their new spine, some other things that are going on. It's fascinating what they're working on. One of the things that he said that I hadn't really contemplated as much is that he says, we're not building AI data centers. We're building AI factories. And that's a very key differentiation, because building a data center is one thing, building a factory is a different thing. Because when it comes to building a factory, the bigger the factory, the more you produce. So the scalability of what he's building at Nvidia versus what is going to be used in terms of AI and all these type of things in the future is very important to consider. And this really starts to play back also into this whole deficit narrative, where we have this never-ending run of deficit into the future, and we're going to have this big bond crash because of this. The one thing that those projections do not include is the impact of future economic growth. And there are some things that are occurring right now that could change the trajectory of future economic growth by just a few basis points. But that change in just a few basis points of growth can make all the difference in terms of the deficit narrative. And when you start thinking about the inputs of AI into increasing productivity, developing new business lines, new technologies, all these type of things that are going to come from AI. There are things that will come from AI that we haven't even considered possible yet, cures for cancer, all these types of things that can be accelerated because of AI that is going to improve economic growth in the future. But it's not just that. It's also all the infrastructure requirements that are needed to support that AI development. And so this is why, in our portfolios, you look, we have power and a lot of other stuff in our portfolio as well, based on this need for future activity. But then you've got to build all the infrastructure for this. It's not just the power grid to support the AI development, these AI factories. It's not just the power requirements for that, but it's the buildings, it's the roads to the buildings, it's the housing developments all around those buildings for people that work in those data centers. They've got to have a place to live. And this goes, and you start thinking down the ladder of all the infrastructure requirements that will be needed. And if that just adds 4 basis points or 5 basis points, in other words, we go from, say, 2.5% economic growth to 3, or even 2.3% economic growth where we are now to, say, 2.7, that changes the trajectory of the deficit for the better. So again, this is the problem with these people that come out and they run this consistently bearish outlook on the demise of the U.S. We're going to lose our reserve currency status, all this type of things. Those arguments hold very little truth in reality. Again, Ray Dalio's the latest one, as we've talked about. He's been running around lately screaming, we're going to have a deficit crisis in 2 years. You better get out, just whatever it is. He's been saying that since 2010. It's 15 years later, he's still in the same shtick. And what's even interesting about that is, if you look back at Ray Dalio's history, he wrote an article once about what was his biggest investment mistake. This was in the early 2000s. They go, what was your biggest investment mistake over the years? He says, well, back in 1980-81, I was talking about this coming debt crisis, and it didn't occur. So this isn't the first time that he's had this shtick that he's working on about the debt crisis that didn't pan out, just like he did in 1980-81. Maybe someday he'll eventually be right. But how much money does it cost you in terms of your investment returns and your future wealth and prosperity by listening to kind of these tail risk events in the markets? I mean, our goal is to grow money. Our goal is to deal with the markets that we have in front of us today, and we can always adjust in the future. If we start to see a debt crisis coming, we'll know it's coming. It won't just wake up one morning and just be here. We'll have plenty of time to adjust for it in the future, but we need to be making money today. And if that event never occurs, that's okay. Peter Lynch, one of the great investors of my lifetime, when ran the Fidelity Mandela Fund, he said that more money has been lost trying to avoid crashes or corrections than actually was lost during the correction. Because the corrections are never as bad as what everybody expects. You never have this devastating end of the market type correction because markets adapt. But secondly, these expectations of these tail risk events very, very rarely occur. If you go back over the last 130 years of the markets, we've had 4 major events in 130 years, right? You had the crash in 1929. That was pretty devastating, no doubt, right? You had the crash in 1974, the Nifty 50. Then you had the dot-com crash and the financial crisis. So 4 big events out of 130 years. Now, most of you aren't going to live 130 years. Your time frame for most investors is much shorter. For most investors, when they're finally to the point, and John will verify this for me, by the time you get serious about saving money and really growing your wealth, it's about in your mid-40s, because you've finally, you've bought your house, you've raised your kids, you're getting them out for school, those type of things. And so finally you're to the point, and your income has grown to a level that you can actually save and invest money. So for most people, that starts around 45, maybe even 50.
Yeah, I'd say late 40s. It's kind of in their prime, kind of that sweet spot when they're getting close to the being 50 years young.
Yeah. And then you've got 15 years to retirement. So for most people, their time frame for saving and investing is about 15 years. And so worrying about something that may happen in 30 years or 50 years from now can have a much bigger impact on your future wealth than the actual event itself.
Yeah, and so I know this will probably go a little bit into what you're going to write for the weekend, but you know, it's when you look at in the moment when we're here, just like this past April, when you're in the moment and markets are pulling down and the media is all over you. I mean, it's just, and it's clickbait, right? It feels like right then and there the world's coming to an end, and then now we're through it, and folks look back and go, "Oh, John, that wasn't so bad. I can take risk. Oh, you know, I didn't mean to blow up your phone. I'm sorry. You know, I was panicking. I was panicking. It's like, you know, but I get it. We're emotional. I get it. But you know, understand the history. Look back and look what markets have gone through. Look what you've gone through in your life, and you're still here." Right. So it's just so easy to get caught up in that exact moment to make that knee-jerk reaction that can really derail, you know, that longer term financial success. Right. Because so if you're in your, as you're kind of getting toward those mid 40s, or you're kind of getting to that, you know, 50 years young, as I like to say, and you're able to, you're kind of in those prime earning years and you're putting away a lot of money, you know, you gotta remember that, yes, markets are going to be volatile. And you could have a lifespan, you know, even when you quote unquote retire. And a lot of folks, in my experience, Lance, they just don't retire and sit on the couch and do nothing. You're still engaged. You are still involved in the community. Maybe you're still working. Maybe you're working a little bit less, but you're still actively engaged. But you may have a lifespan of 30, 35 years. So this money has to be set up to support you moving forward. Do you need to be in a 100% stock portfolio? Probably not. Right. But to have some of your money positioned for growth so you can fight inflation, keep your purchasing power, do the things that you want to do. So that way, the concern that you really expressed to me when we're putting together your financial plan of, yeah, the market volatility is on your mind, but when we really start peeling the onion back, it's, John, I just don't want to be a burden to my family. Okay, well, let's set this up so that your portfolio will support you through the ups and downs of the market, right?
Well, and this goes back to, you know, we've talked about as well in terms of, you know, talking to clients that is like, oh, I've got to pay for my kids' college. It's like, okay, well, that's fine, except you're going to be broke on the other side of this. So now you're going to be a burden on your kids when they graduate college. Is that really what you want? Yeah. Right. Or
I've had a number of folks just tell me, hey, you know, I'm just going to move in I'm going to move and live with my kids when I get older. It's like, well, do your children know that? Have you spoken with them? Or surprise, here's my retirement plan, Audrey and Andy. I'm living with you.
Audrey and Andy. But yeah, I mean, these are the, you know, the things that we don't think about.
Yeah.
But again, at the end of the day, when we come back and we talk about, you know, investing and growing money and those type of things, it's a function of making good, sound decisions that aren't emotionally driven. Again, you know, we go back to the beginning of the show and talk about anchoring and those type of things. So, you know, try not to fall into that trap, because these are the things that we fall into on a real regular basis. So, you know, again, it's just, we can do better. We just have to pay attention to what we're actually doing. So, all right, that wraps up the show for the day. Again, you can now watch the show live on both YouTube as well as X. And so, again, we're trying to expand our number of platforms. So we appreciate you putting up the test feed for today. We'll be back with our regular feed tomorrow, now that we know that Restream is actually working like it's supposed to. And have a great day. We'll see you then.